Don't fool yourself. Granted, this is an early warning for the US over the next 5-10 years, but it will happen, mark my word.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed.
The first things first, yesterday, markets had a good rally, right? We saw a pretty solid move to the upside. Ultimately, we closed almost at the highs of the day. It looked like things were returning to the so-called normal. Problem was, last night, right, about 8 p.m. Eastern time, maybe 9 p.m. Eastern time, the futures began to decline. And essentially what happened here was China reported that imports declined by a whopping 12.4%. Think about that. Imports into their country down 12.4%. Exports, which is them exporting to the rest of the world, declined, let me get this right, 14.5%. Think about that. 14.5% year-over-year decline in exports. Now, if you just look at this data, what does it mean? Well, imports tells you that their economy is in dire straits, right? Their consumers are not consuming, their consumers are holding their wallets and not spending. So that's a huge negative. Now, we already knew that China was in trouble, right? We already knew that China basically was stimulating because their economy was stalling so quickly. The government's told us that. But the kicker here is that if you look at the export number is the worst number since basically COVID crash. We're talking back in early 2020, March, April, May of 2020. Think about what was going on in the world at this point. We were basically back then thinking there was going to be total, dysfunction. Everything was ground to a halt. There was lockdowns. And again, it made sense that people weren't spending because they were freaking out that the world was going to end. Obviously, it didn't. But the point is, this export number tells us that not only the globe is slowing, but it gives us insight into what the US economy is likely doing as well. So that's a kicker, and we saw the future starting to decline. So right now, I want to show you this. This is the S&P 500, and ultimately what we're seeing here, this is the daily S&P. We're basically seeing big red candles starting to form, guys. And this is the opposite. And the reason why I'm drawing your attention to this is because if you go back here, big red, green, green, big green, big green, big green, small red, small red, small red, small red, big green here. Look at the switch that we've seen, right? So we've seen this switch where we're now getting big red candles, which is telling you that bigger volume on the sell side is coming in. This is institutional volume. So you had the gap up here and big reversal. Then we got small green, small red, big red, small green, big red. Decent green right here, not as big as this, but you know what? Today, the S&P futures are negating that entire move yesterday coming into the open. So my point of drawing your attention to this is there's been a fundamental shift in price action. All right, not only were we making low, higher, low, higher, low, higher, high, higher, high, higher, high, we're now making lower high, lower high, lower high, lower low, lower low, along with the candle function, meaning the big reds are now starting to form while the greens are small, which is the inverse of what we saw over here. All right, so I want to go over here. We're going to take a look over here, guys. Let's keep this thing moving here. So I want to show you now talking a little bit about cycle analysis for the Nasdaq, all right? So what we have here is the Nasdaq. This has been an amazing rally, absolutely amazing rally. The reason why bulls are so confident in this rally is because it is the longest bear market. If it's a bear market, it would be the longest bear market rally in history, right? So epic move to the upside here, longest period. But what I have a concern about is this, is that you basically have a cataclysmic event brewing where you have the fastest rate hike cycle in history, and now you have the longest potential bear market rally or maybe bull market beginning as well. And so they both can't be right. You either have interest rates that are going to eventually cause this to roll over, or you have a new bull market that's going to come up to double top, maybe pull back, and then break to the upside. So which one is it? Well, what I love to do is I love to look at the charts. And the charts, they're just very simple. It is what it is on the chart. And as a chart reader, that's what we have to do. So as long as we're below this pivot high, that pivot high is the dominant pivot point on the chart. It is the highest point. As long as we are below it, you have to respect that high. Now, if we flip back to past cycles, All right, so let's go back to the past cycles. Let's go back to, which one is this one? 2007. So in this situation, here was your dominant high. We pulled back, we had a big dump, and then look at this. This kind of chop action before the big dump out into the lows of 2009, essentially the end of the bear market, culminated with this flush out here. By the way, we haven't seen that type of flush in this market yet, just a heads up on that. But notice this price action. Notice the down, bounce, pullback, bounce, and then go to the current cycle, down, bounce, down, and then kind of bounce up. It's very similar. It's very similar as people are lulled into this false sense of confidence that this is a new bull market. Now again, the bulls will tell you, and they could be right, listen, anything is possible, right? Everything I do is probability based. There's never 100% of anything. So there's always a chance that the bulls could be right. This is a new bull market. But again, for me, that's your dominant high. And again, yes, were there people saying this was a new bull market here? Here, absolutely there were. And what we know is that in the tech bubble, it continued to collapse into '01 and even into '02. So again, my point here is just to show the similarities from past big cycles in the Nasdaq to make sure that people at least are informed. You don't have to listen to what I say. You do what you want. You got to make your own decisions. That's what this is all about. But I want you to understand when you're hearing the mainstream media and all these economists talking about bullishness and this is a new bull market and everything's going to be fine and it's going to be a perfect landing, you have to understand past cycles and how they worked out. Now you might say, well, why is this bear market rally, if it is a bear market rally, why is this one the longest one in history? Couple reasons. Number one, I think the labor market has stayed strong because again, you have people that companies, employers that it was so hard to find employees that they don't want to fire them right now. They're hearing that it's going to be a soft landing or no landing at all. They're like, man, it took me 2 years or a year to find this qualified person for this job. I don't want to let them go. But that's just one point. The other side is that you had so much liquidity pumped into the market during COVID and the years following COVID that liquidity does take a long time to dry up. And that can create longer bull or bear market rallies, in my opinion, like this. Throw in the AI craze, and again, you have the makings of why potentially this could still be a bear market, even in spite of it would be the longest bear market history rally. All right, so that's a couple things. The other thing I want to just point out here, guys, is that there's a credit crunch or credit crisis brewing here. And one of the things I want to point to is Italy, right? In fact, let's bring it back to the center console here. So in Italy, right, you basically just got an announcement from the government that they're going to do a 40% windfall tax on all bank profits. Let's rephrase, let's think about this. So again, folks, 40% tax on all profits across the board for banks in Italy. Now, where's this coming from? Well, I'll tell you. This is what is going to become more and more normal, and I'm going to tell you why. When you have deficits, when you have debt to GDP ratios of where they are for countries, and you're talking about the US at like 130, 140, Japan 250% debt to GDP. I don't remember what Italy is, but it's over 100% for sure. And ultimately, when you have that, these countries are going to have to raise tax revenue to pay the debt down. All right, either that or they're going into default. And default, again, imagine the US going into default, let alone the credit crisis that would be unfolded if Italy and some of these other countries went into a credit crisis from default. So there's going to be more of this, and this is going to panic investors more and more. It's the beginning. I'm warning you, this is the beginning of it, but over the next 5 to 10 years, you're going to see more of this because these countries have to raise tax revenue. In addition, what's going on in Europe is you have a massive slowdown. So what kind of tax revenue are they really getting when there's such a big slowdown? So their tax revenue is declining, their deficits are spiking, which by the way is the same thing in the US, and they're going to have to figure out. And you might say it's not going to happen here in the US, but don't be surprised. If it comes down to either the US defaults or they levy X amount of tax on corporations, they're going to levy that tax on corporations. The corporate tax rate will go up to compensate. So don't fool yourself. Granted, this is an early warning for the US over the next 5-10 years, but it will happen, mark my word.